Let's start with a bit of a background for context out here. On 2nd June, Bloomberg Economics published an inference, though not a disclosure. From the movements in the composition of India's reserves, its India economists estimated that the Reserve Bank of India had likely sold roughly $12 billion of coal in 2 weeks to 22nd May, while adding up to $7.5 billion in foreign currency assets. This seemed like a rotation to defend a rupee sliding towards 97 as the US-Iran confrontation drove the Brent past $100. The RBI and the government's PIB fact-check unit rejected the claim within a day. The rebuttal rested on two figures. The physical stock of gold was unchanged at 880.52 tons as on date, and gold's share of reserves had risen from 13.92% at the end of September 2025 to 16.70% on 31st March and 16.185% as of 22nd May. The opposite of what a fire sale would produce. Now read this at face value. The exchange looks like clean win for the central bank. However, read this against the calendar. It's something stranger, a rebuttal that does not actually cover the period in dispute. Hello everyone, welcome back to our channel and welcome back to the Fourth Line series. This series is a weekly reading of the multipolar order, and today we're going to focus on the world currencies. And within the world currencies, let's focus on India today. Today we're going to talk about the denial and the drawdown and how India's reserve opacity is becoming a policy instrument. The June dispute over whether the RBI sold 12 billion of gold was never resolvable, and that's the point. India has acquired a reserve management doctrine in which denial and drawdown coexist inside the reporting calendar, and an intervention posture that makes the ambiguity useful. For the allocators, the question was never whether the sale happened. It is that a structural accumulator's bullion is now a contingent FX liquidity, and its disclosure seen is now a policy instrument. Let's start with a bit of a background for context out here. On 2nd June, Bloomberg Economics published an inference, though not a disclosure. From the movements in the composition of India's reserves, its India economists estimated that the Reserve Bank of India had likely sold roughly $12 billion of coal in 2 weeks to 22nd May, while adding up to $7.5 billion in foreign currency assets. This seemed like a rotation to defend a rupee sliding towards 97 as the US-Iran confrontation drove the Brent past $100. The RBI and the government's PIB fact-check unit rejected the claim within a day. The rebuttal rested on two figures. The physical stock of gold was unchanged at 880.52 tons as on date, and gold's share of reserves had risen from 13.92% at the end of September 2025 to 16.70% on 31st March and 16.185% as of 22nd May. The opposite of what a fire sale would produce. Now read this at face value. The exchange looks like clean win for the central bank. However, read this against the calendar. It's something stranger, a rebuttal that does not actually cover the period in dispute. So what's the theme out here? The 10 is in which numbers are in quantities and which numbers are in ratios. The only series that publishes physical tonnage is the monthly bulletin, and its reserve data ran through 24th of April, roughly a month before Bloomberg's 22nd May window. Within that window, the tonnage was genuinely flat at 880.52 tons, but the window ends before the fortnight anyone was arguing about. Now, the figure that does reach May 22nd, that is gold's 16.85% share, is a value ratio, gold's value over total reserves, not the count of the bars. In the week to 22nd May, gold value, foreign currency assets, and the total reserves all fell together. A ratio can rise on that mix even if the tonnage is flat or lower, simply because the dollar sleeve fell faster. The share cannot refute a quantity claim because it is not a quantity. None of this means that the inference was right. It carried two independent weaknesses. A roughly 5% correction in the international gold price across the contested weeks accounts for most of the value decline at the constant tonnage, and also the duty premise behind it does not bind because the RBI marks reserve at international and not domestic duty-inclusive prices. So essentially, the honest reading in early June was that neither the sale nor the denial was checkable. The RBI had refuted on 22nd May quantity claim with a 24 April tonnage line and a value ratio, and the analyst had inferred a sale from the valuation move. Now, this is not the first time that this has happened. In October of 2019, the RBI issued a near identical denial when a weekly supplement was read as active gold trading, and the answer was a change in the devaluation frequency, not sales. Now, the same is not an accident of one fortnight. It's a permanent feature of how the reserve data is disclosed because tonnage lags, and this means that a drawdown and a truthful denial can occupy the same page of the calendar. So essentially, when we say that the denial and the drawdown can occupy the same page of the calendar, that is not a failure of disclosure. Increasingly, it is done by design. Let's talk about the doctrine next. What has changed since June is not the data, but the reaction function sitting behind it. And that is the real story. By July, the rupee had run to near record lows, down almost 2% on the month, with the weakest showing in Asia, underperforming even oil-sensitive peers like the rupiah, the peso, and the baht. Now, that residual, that is the weakness beyond what the oil bill alone explains, points to India-specific factors and crucially to a central bank choosing not to spend to stop it. Governor Sanjay Malhotra had said that the bank would do whatever it required to keep the moves orderly, and traders expected a floor but did not get one. Now, reporting since indicates that the governor and his deputy both brought in from outside the institution favored letting the currency adjust to the macro fundamentals, mainly intervening against the disorder rather than the direction. Bank veterans on the market operations side reportedly prefer heavier, more regular intervention to discourage one-way bets. The current leadership does not. Now, this is the doctrine break from the earlier years when the rupee was held in unusually narrow band and implied volatility fell to multi-decade lows. The manufactured calm is gone, replaced by a stated willingness to conserve reserves and let the currency clear. Now, there are two things that make that posture matter for the gold question. First and foremost, the financial year 2026 annual report showed gains from foreign exchange transactions jumping 52% year-on-year to 1.69 trillion, the fingerprint of heavy dollar selling through the years. This is consistent to the reserves falling 7.5 billion in a single week to the 22nd of May. The RBI has been intervening. The argument is only about which sleep. Secondly, a central bank that has decided not to burn the headline reserves has every reason to rout what defense it does undertake through the least visible, most lagged line on its own balance sheet. Now, that is precisely the line that the disclosure seam obscures. Opacity stops being a quirk of the reporting cadence and becomes usable, an instrument, not an accident. And by early June, the market had in effect adjusted the narrow cushion ahead of the RBI. An independent reverse calculation smoothing the valuation noise against the stable benchmark concluded that some physical gold most likely did leave the balance sheet in May, a modest tactical drawdown to defend the rupee while conserving liquid dollars, not a panic sale. The official tonnage that would confirm or deny will not appear until half-yearly reserve management report referencing the end of September, and it's published later in the year. The doctrine will have moved several fortnights on by then. The confirmation when it comes will be an epilogue. And finally, let's wrap up with the fragmentation frame out here. Now, step back from India, and the episode reads as a data point in the broader migration. Gold's share of the reserve stack has climbed as the central banks treat it as a hedge against the dollar and geopolitical risk. India has repatriated bullion until roughly 77% now sits domestically, up from 59.2% a year earlier. The same instinct that brings the gold home reduces counterparty and custody dependence in a fragmenting order. It also converts it under stress into contingent FX liquidity that can be tapped quietly. That is the uncomfortable synthesis out here because gold is simultaneously the asset that the middle power accumulates to escape the dollar system and the asset that it reaches to for defending its currency within that system. The two uses are not in tension, they are the same reserve doing sequential jobs. And every reserve manager watching the June dispute learns the same lesson. The RBI is demonstrating even a structured accumulator's bullion is latent dry powder, and the disclosure architecture will let you use it without saying so. And that is exactly what makes this a fault line rather than a footnote. It generalizes. Now that's all that I wanted to share with you in this video of fault lines. Stay tuned in for our next one.